Hey, welcome back. I'm Johnny Dugan, and in this video, we're going to talk about the 3 best things you can do to prepare yourself for applying for a mortgage. I got my PowerPoint, I got my cheat sheet. Let's talk about it. Hey, welcome back to the channel. I'm Johnny Dugan with Anchor Real Estate Advisors, Anchor Premier Realty Group, and Mountain Mansions. Pick one, look us up. And I wanted to talk about this subject today because I ran into a friend of ours, local teacher here, and she said, "Hey, Johnny, do we need to have perfect credit to buy a house?" And I knew she was renting, and I said, "There's a real simple answer." But my response was, "Are you looking to buy? I know you're in a rental." And she said, "Well, we just re-signed a lease, and the rent has gone way up on us." And we thought, well, shoot, if we're going to be paying that much, maybe we should be owning. But she was concerned about her credit. Now, for her, it turns out her credit was actually not that bad. And the short answer to her question is, no, you don't have to have perfect credit to get a mortgage. However, the better your credit is, the better your terms are going to be, and the tens of thousands of dollars you're going to save, or the bigger, better house that you can get based on your credit. So what I'm going to say is good on her for asking the question a year out, right? Not waiting until she's a month away from her lease ending. And so what it got me to thinking about are ways to improve or prepare for applying for a mortgage. So in this situation, what we're seeing a lot, okay, even though house prices have gone up, what has gone up just as much is rentals, if not more. In fact, rentals remain unchecked. Home prices have flattened out because the government can raise interest rates. Well, they can't really affect rentals quite the same. So those rates continue to skyrocket. And so we're seeing this pendulum swing of a lot of people kind of being forced into rentals because of the high home values. But rents are so high and people are paying so much, they're kind of coming back and saying, well, if I'm going to pay this much, I'd much rather be owning. So we're going to talk about the simplest ways, most straightforward ways, kind of high level topics of digging in and preparing yourself and your credit for applying for a mortgage. All right, so the way I'm going to cover this is I'm going to talk about your overall credit snapshot. I'm going to call it quality of credit. And there's major components of your credit, and it's not just one or the other. So the 3 biggest things are credit score. That's what lenders are looking for. Credit score, okay? Your debt to income ratio, and your certainty of income. Now, I'm going to explain all of these and break them down in a second and how you can improve them. But what I'm going to call these are the big rocks of what the lenders are looking for. Credit score, debt to income ratio, and certainty of income. There are other elements of it. Don't beat me up over too many nuances, but if you concentrate on those 3 things, that will cover about 80% of your overall quality of income picture. Okay, so let's talk about each one. All right, so the number one thing that lenders look for is your credit score. Now, most people understand that they have a credit score. Some people have an idea what their credit score is, but not everybody really understands what it is, what makes up your score, and how it's calculated. And I'm going to get into that in a minute. But what the biggest thing I want people to understand about your credit score, it's really a snapshot of your consistency of being able to pay back debt. Okay? So understand it's got nothing to do with what you got in the bank. It's got very little to do with how much money you make. Your credit score is primarily based on your history of paying back debt. Okay? So there's ways to, I don't want to say manipulate it, but it's certainly ways to improve it intentionally by doing very specific things. I'm going to get into that. Okay? So the number 1 big rock was credit score. I'm going to get into it. The number 2 thing is debt to income ratio. What is your debt to income ratio? Simply stated, it's the amount of money that you have to pay every month towards debt divided by the amount of money you make every month before taxes. Okay? That is your debt to income ratio. It's not I owe $60,000 on my truck and I make $70,000 a year and I divide those numbers. That has nothing to do with it. It's all about your monthly payment, your monthly nut roll towards debt versus your total pre-tax income. Okay? That's calculated on a monthly basis. And most mortgage companies want to see that number, that percentage, below 40. Now, there's a lot of nuance here, but most companies is between 35 and 43, and there's all kinds of different numbers. But we want that number to be as low as possible. And we'll talk about the best ways to do that. But I wanted one thing to understand about debt to income ratio, say versus credit scores. Basically, the better your credit score, the better your rate will be. Where in debt to income ratio, it's about a threshold. You want to get below a certain threshold in order to qualify. If you're below the threshold, you qualify. If you're above the threshold, you don't qualify. So we want to get our debt to income ratio below the threshold, and then it's always good to keep getting that ratio down as far as we can. Okay, so I'm going to talk about ways to do that. So the third big rock, first one's credit score, second one is debt to income ratio. The third big rock is your income certainty. And what does that mean? Mortgage lenders simply want to be able to know that you are going to be able to keep your current income steady, no breaks, steady Freddy, okay? It's better for you to make a little bit less money, but be steady. Your income every month is the same. It's even a little bit lower. That's fine. The lenders would rather see you making a little less money, but perfectly steady, than they would say, oh, I'm in sales and I can make $100,000 a year, but I make $20,000 this month and I make, $1,500 the next month. That's not as good. They'd rather see you make $70,000, make less money, but it be paid every 2 weeks, for example. Now, it's not a requirement to be paid every 2 weeks, but I'm saying in the eyes of a mortgage lender, they're looking for steady Freddy. So certainty of income means not only do you have a job, but you've had it for a while, and it looks like you're going to have it for a while. So that's what it means. And I'm going to talk about ways to make that look as good as possible, and certainly ways to protect that. All right, so those are the three big rocks: credit score, debt to income ratio, income certainty. How do we make them better? So credit score, understanding what makes up a credit score is the most power you can have. 35% of your whole credit score is based on-time payments and payment history. Doesn't matter how much you've paid. You could have made a $10,000 payment this month and a $50 payment the next month. What the credit score and the 35% is based on, that it was on time. That over time and over the years, you've paid your debt payments on time every month. Again, doesn't matter how much, so long as it's paid, so long as whatever you had to pay, minimum payment, monthly payment, car payment, whatever, paid on time every month. And the reason why I keep saying it and beating this dead horse is it's 35% of your credit score, and it's simple. On-time monthly payments. I'm a big fan of auto pay. I'm going to get into that in the encore after I wrap up the basics. But 35% of your credit score is based on-time monthly payments. So how do you make it better? Look at all your debts and look at your payment system, okay? And make sure that all your debts are paid every month right on time. I use auto pay for that. Put an emphasis on making sure they're paid. In fact, I say the 25th. 25th is easier to remember because that's Christmas Day. Pay all your debt payments on the 25th. And if you pay it on the 25th, well, next month, it's 30 days to the 25th. It's not like you're paying it early, and it's still every 30 days. But to your lenders or to your debtors, it's early, it's great, you're in a great position. That's my suggestion. That, again, 35% of your credit score is based on just on-time payments, okay? The number two thing that makes up 30% of your credit score is the percentage of use of your revolving credit. And for most people, revolving credit equals credit cards. You use it a little bit, you pay it off or pay it down. You use it a little bit, you pay it off or pay it down. That's a revolving credit. The percentage of use is, well, I've got $10,000 worth of limit on my credit card, and I'm using $2,000 because I just bought a cruise, okay? I got $2,000 on my credit card. That means my credit card usage is 20%, okay? The threshold that the notes here mention is you want to keep it to 30% or below. I want to see that number lower, but understand what lenders are looking for is for that credit usage to be as low as possible. So pay down your credit cards, okay? That's the simplest way to bring down that percentage usage of debt. So those two things, on-time payments and paying down your revolving credit, is 2/3 of your credit score. If you do those two things, that will take care of 2/3 of your credit score, okay? Lean into those two things, all right? So debt to income ratio, how can we make that better? So again, understand it's the payments you make towards debt divided by your pre-tax income. So how do we get our debt payments down? Well, you have to look at your debts and see which ones that you can pay towards or pay down that actually affect your monthly payment. So let me give you an example. If you have a car and you owe $10,000 on it, until you pay off all $10,000, your payment stays the same. Okay? So $10,000 car or $10,000 car balance, and you have, let's say, a $500 payment. You also have 3 credit cards. They tally up to say $5,000 total, and they also have a $500 payment. That's how much you make in total payments to your credit cards. And then you hit a nice scratch off, and you have $5,000 to pay towards your debt. What do you pay? Okay. Well, debt is debt, right? Pay it towards your debt kind of doesn't matter. Not true. Pay it towards the highest interest rate. That doesn't matter either in this case. You want to pay it towards the debts where when you pay them, it will knock down your payments. In this case, it's going to be the credit cards. If I pay $5,000 towards my car loan, it doesn't change my payment. But if I pay $5,000 and I pay off or pay down these credit cards, my minimum payment will also come down. Okay? So, debt to income ratio, how do you make it better? You pay off the debts that then reduce your monthly payments. Okay? Again, that's going to end up for most people being revolving credit, which for most people is credit cards. So, the two big rocks that we talked about, credit score and debt to income ratio, the best way to improve both of them, on-time regular payments and pay down and pay off your credit cards. And in life, that's good. Regardless if you're trying to buy a home or not, the credit cards and getting rid of them is the best way to go. All right, let's get those paid off, and that will take care of the vast majority of your credit picture. All right. The third thing is your certainty of income. All right. What I said before was this is a lender making sure you're steady, Freddie, and you can keep making what you're making on a regular basis without any gaps, etc. What's that mean? To improve it, keep your job. Even if it's not great in the context of buying a home, what the lenders want to see is steady, regular income. So if you got that job that's a little bit of a slog and you've been thinking about moving on, wait until you buy the house. If you've been thinking about starting that business, even if you've got contracts lined up, just wait until after you purchase the home. Even if you know you're going to make more money, wait, because starting a new business, as fun as it is a mortgage killer. It's a mortgage application killer. If you just started a new business, you're within 2 years of starting a new business, it can be a mortgage killer. Now there's some caveats to that, but for the vast majority of folks, that is a way to kill a mortgage application. And I can say that from experience. I considered leaving my job. I had a business that I had already started. I had contracts lined up. And I talked to a mortgage lender, and he said, if you quit your job and go into your business, I don't care how much you make, but you're not going to get that mortgage you want. So keep the job and kind of wait it out until you get your mortgage. Now, the only caveat to that is if you change jobs, but you stay in the exact same industry and there's no gaps, that's okay. So if you're a nurse and you just take another job at a different hospital and there's no gaps, you finished on a Friday, you started the next Monday or something real short, that's fine. If you're a mechanic and you take another mechanic job, go from Chevy to Ford, I mean, who would do that? But you do that, that's okay too. But if you're a mechanic, don't start a new shop and say, hey, I'm going to make a whole bunch more money. I'm already making more money. Don't do that if you can help it in the context of preparing to buy a home. All right, so we talked about the positive things you can do to affect your credit, your quality of credit. Let me tell you what not to do. So either you're protecting your position or you just want to make sure you don't mess up the good momentum you've got. Number one thing, no new accounts, even if they seem simple, like a gas card or that 0% rooms to go card. And they seem real simple, but new accounts, regardless of their scale, they look bad to creditors. So just avoid them. And if you were thinking about buying a new car, if you don't have to have it, regardless of even if your payments would be the same and all that jazz, no new accounts. Just hold steady until you get through your mortgage. All right. The second thing to protect yourself, no new big charges. So a lot of people will put vacation on their credit card and pay it off over 2 or 3 months. This is a slippery slope. And what happens is a lot of times people make a big charge, and then life happens and they've got that charge on their card for months and months. Where if they just kind of avoided it and cash flowed it on the front side, it would have avoided the big charge. And then when you go in to buy the house, you don't have this big hunkin' debt hanging over you. Plus, if you have the debt, and even if you can afford the payment, if your percentage of credit usage is high because you made that one-time big chunk purchase, that also looks bad. So to the furthest extent you can, no big purchases, all right? The third thing here I want to talk about, and this is counter to advice I give in the rest of life, but when it comes to credit cards, if you have credit cards and you're paying them down, fist bump, get her done. However, normally I'd say cut them up. In this context only, pursuant to a new mortgage, go ahead and keep the accounts open. Good standing accounts look good to mortgage lenders, especially if you're not really using them. And so, again, it boils down to the percent of credit that you're using or percent of available credit that you're using. So if you have 4 credit cards and they tally up to $10,000 worth of usage or worth of availability, and you're only using $1,000, well, you're at 10% usage. That's fine. If you cancel all these other credit cards and you've got one card that's, say, a $2,500 limit and you have $1,000, well, that's now you're at like 50% usage, 40 or 50%. So life happens. Sometimes you got to buy tires for the truck, that kind of thing. And if you have to slap it on the credit card, you don't want your percentage of usage to spike because you only have one card. So in life, don't carry a bunch of credit cards, just cut them up. But pursuant to a mortgage, if you already have them, okay, don't go get new ones. But if you already had them and you've had them for a while and you've paid them off, that's awesome. But just go ahead and keep those accounts open until you get the mortgage and then cut them up. Cut them up, cancel the accounts. All right. So I'm going to dive into the Encore. I'm going to talk about some strategies on on-time payments. I'm going to dive into some things that I did. I'm going to tell some personal stories. So I hope to see you all on the backside of that. But otherwise, if you take nothing else away from this video, on-time monthly payments, pay down your credit cards, keep your job. Those are the 3 biggest things. All right, y'all. I'll talk to you. Hopefully, I'll see you on the backside when we get into the Encore. All right. Have a good one. TYJ. All right, welcome back to the Encore. So this is the part where I take off my tie, and I kind of relax a little bit, and I kind of want to get into some detail, and I want to tell a little personal story because I like it when my advice givers have lived through the advice. And so in this case, I want to talk about some of the strategy I use to build and rebuild my credit, and then a little bit deeper dive into some of the things I use. So it doesn't work. It's not necessarily for everybody, but it is things that definitely work. So let's get into it. So the story on me goes, I found an interest in real estate at a pretty young age. I bought my first house, like I say, way back in the 1900s and 1998, in fact. And I ended up moving and renting the house out. And by the time I sold the house, I ended up making a little bit of money on it. Now, that part was cool. I already liked real estate. And then I saw this, this really fun job in real estate investing. And so I wanted to lean into it. Started a company in 2005 with a partner, and I started buying and flipping and renting houses. Kind of pretty straightforward, real estate investing story. However, I had a handful of houses when the market crashed in 2008. As a result, they were impossible to sell. They were nearly impossible to rent. Certainly, they were going to rent for way less than what my mortgages were. So I ended up short selling 3 houses. And I also had a couple of personally backed business cards that I used for flipping houses. And I'd use those to make these houses nice. And then when the market crashed, it crashed so fast and they didn't sell. So I had big time credit card balances and I had homes and there was nothing to back them up. So between those, I came out of that and I was able to settle it all out, but not before just smashing my credit. So I had perfect credit going in and I had horrible credit coming out and I had to rebuild it. So the strategies I'm going to talk about are kind of, at least me personally, pretty tried and true in regards to building the credit. And that's kind of where why I gave the advice I did. So the first thing I wanted to talk about was the credit score. What I mentioned on the first part of the video was the number one way to improve your credit score is to have on-time monthly payments. All right. How do we do that reliably? Okay. How do we never forget a payment? So for me, I pay the bills. I'm the one that actually goes in and makes sure all the bills are paid. Now, I don't want to just accidentally forget something. Wicked ADD as it is, and so I wanted to develop a system that would kind of be foolproof for me. So earlier in the video, I mentioned auto pay for your bills. Some people shy away from auto pay because they feel like they're not sure when it's going to come out or it's inconsistent with their paychecks, etc. So my system kind of takes some of that out, but it's a little different. And what I would do is for the longest time, I got paid every 2 weeks. Okay. Some people get paid every 2 weeks, some twice a month, whatever. And what I did is I set up my auto pay to pay half of my bills every payday. And when I say half my bills, I don't mean I paid some bills on the first paycheck and some bills on the second paycheck, which that system kind of works too. But I paid half of every bill every payday. So if I had a $500 car payment, I paid $250 every 2 weeks. I paid, if it was a credit card, if it was even my electric bill. And you go, well, how'd you do the electric bill? I looked at whatever my average was going to be, my average bill was going to be. I estimated a little bit high. And if my water bill normally was, $80, I'd pay $50 every 2 weeks. And then I'd build up a little credit with the water company. I didn't mind. I'd much rather pay everything early and on time and have $100 big deal credit at the water company than, oops, I missed a payment. Now they're sending me a letter saying, hey, you got late fees and all of that. And so I would pay half of all of my payments every payday. I would schedule my auto pay to come out basically the same day as my paycheck. Now, I also recommend that whenever possible, you do direct deposit. That's the most consistent way to get paid at a consistent time. And I'm not talking about, you don't have to get paid every 2 weeks or every other month. The key here is consistency. Now, if you don't have direct deposit, you probably still get paid the same time, every 2 weeks or weekly or whenever you get paid. There is a way for you to make it regular. So if you get paid and they hand you a paycheck, you deposit it. Okay. Most banks take ATM deposits now, right? You deposit it same day, even if it takes 3 days to go into your account. You know this. So you get used to that cycle and you schedule your auto pay for the same day or maybe the day after your paycheck goes in. All right. The reason I did all this is it makes budgeting super simple. It makes sure everything is paid without a doubt. And it's cruise control. So long as I work my job and I know I got paid. No, I still check all my accounts. I still look at my bank statement. I still look at my electric bill, my water bill. I'd make sure there was a little credit with each one just to make sure I wasn't grossly overpaying. Certainly was make sure I wasn't underpaying. And then every so often, like every 6 months to a year, I might adjust how much I was paying towards utilities if I was building up a bigger credit. But the bottom line is, for over a decade, I worked my system that exact same way, and I've never missed a single payment. Why? Because they're all made for me. So I understand it's a little bit aggressive, but I've had several friends adopt this process because every 2 weeks, my my budget is exactly the same. And then every Tuesday I'd have whatever left, $200, $300, $400 or whatever. And I also auto transferred money into my savings account. And so whatever was left was basically mine to spend. And I knew, and I had a lot of confidence, and I knew everything was paid. I didn't worry about it. Bang, 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 auto pay, schedule it. I suggest you schedule it for paydays and get it done that way. And if that makes you nervous, build up a little buffer in your account. That's another little pro tip. Put a little buffer in your account, maybe $2,000, $1,000, $500, doesn't matter. But in your brain, call that zero. When you get down to $500, that's basically zero, and you don't have any more money to pull out of the account. All right. That's somewhat of a mental trick, but it's one that works. And then it eases your mind when scheduling these auto pay. Okay. So that's, I lean hard into the auto pay to make sure everything is paid. And because it's such a huge effect on your credit score. All right. The next thing for building credit, this is another pro tip. This is another thing that I did to rebuild my credit. So as much as on-time payments are important, you need to have something to have payments too. So the truth is, when all this kind of went down for me, I actually had a paid off car. I didn't have a car payment. And so I needed something to make payments to show that I could make regular payments. Well, I couldn't even qualify for a basic credit card. So what I did was I went out and I applied for a secured credit card. What's that? It's a credit card that you send the credit card company money. I sent them $1,000 and they sent me a credit card with a $1,000 limit. Now, it sounds like a prepaid card. It's not. It fully functions like a credit card. You're free to use it for whatever you need. You pay it. You pay on it. Everything functions exactly like a credit card. The only difference is your limit is only the amount of cash you've already deposited. And worst case scenario, if you ever couldn't make the payment, the bank already has the money. And so it's much less risky to them. There's a couple of benefits here. You now have something to help yourself establish credit. It's a relatively low credit limit, and they're not going to just bump it up on you. I've had that in life where I get a letter that says, "Hey, good news, we've bumped your credit limit from $3,000 to $5,000." They'll do that from time to time, and that turns into a slippery slope. So it keeps your available limit low, and it gives you something to make payments on. So what I suggest is when you're trying to build credit, this is only if you need to be building your credit. You're not trying to go from a 650 to a 680. It's if you're at, say, a 620 or lower and you're trying to get it up. Or if you just have no credit. This is a good way to establish credit. So you get a secured credit card, then you go out, let's say you get a $1,000 credit card. You go out and you spend less than 10%. So, and I don't care what you buy, scratch off tickets. A stereo, subwoofer, I don't care, but make it 10% of the balance or of the credit limit or less. Go have fun with it. Then make the minimum payment on that card every month in perpetuity until your credit gets better. Keep making the minimum monthly payment. It's a cheap purchase. The interest that you're paying is not costing you a whole lot. The value is in the regular monthly payments and having something to pay on. So if you're trying to establish credit or you're trying to rebuild some poor credit. Now, a minute ago, I said no new accounts. Right. No new accounts if you have credit and you're protecting your credit. If you need to build your credit, you're going to need an account that you can be paying on. Secured credit card, buy something silly for less than 10% of the limit, and then make the minimum monthly payment for forever until either it's paid off and you can buy something else, or as long as you can. Because what's most important here is that you're making regular monthly on-time payments. All right, so the last pro tip here. One of the things and it's in this sheet here, everybody that says if you're trying to keep your credit good or increase it, they're going to tell you to run your credit report. I didn't mention this on the front side because you can run your credit report and it may or may not do anything for you, okay? You just now have a bunch of data that you can stare at. And the other thing is when you run your credit report, it doesn't tell you your credit score. It just tells you what's on it. Now, there is value there. Let me tell you what the value is. If you do run your credit report, and it's easy to do, annualcreditreport.com, one good thing the government did is they made it to where all Americans can run their credit or get their credit report from each of the 3 major bureaus once a year. Okay. Now, that also means because there's 3 bureaus that you can get one in January, you can get another one, say, in June, and another one, say, in September. The only issue is the 3 bureaus, they independently report. And so one of the bureaus can have a great score or a great history, and the other one could have not so great because there's an issue or something else didn't report to it. So my advice is to get all 3 of your credit reports at one time and start scouring over them. What are you looking for? What you're looking for is anything that doesn't look like it really belongs to you, okay? And make sure that everything that shows is correct. So what's that mean? That means if you've had a car payment, okay, for 3 years, and you've never missed a payment, but you look at your credit report and it shows that you were late one time, that's a mistake in their reporting, and you can contact them and get them to correct it. Okay, that's kind of one thing. The other thing is just flat mistakes. Somebody at I don't want to pick on anyone. Somebody at Best Buy says, "Hey, do you want to put this stereo on credit?" And the person says yes, and go, "Okay, what's your Social Security?" So they put all the information there at the register. Let's say they plunk in yours by mistake. They hit go, they run the whole credit and everything, comes up and they go, "Oh shoot, that was a mistake. That's not you." But you now have a ding on your credit from it. Those things are fixable when you notice them. But until then, they can ride on your credit. 99% of the time, it's just clerical errors or mistakes, but that most of the time they can be fixed. So you'll run your credit report, okay? You'll get a copy of your credit reports. You'll look at them and you'll just make sure that everything on there belongs to you. Yep, that's my car. Yep, that's my credit card. And then you'll look and make sure they look like they're reporting. 2 things you can do. If you see something that's wrong, you can contact that lender or that credit card or whatever and say, "Hey, there's a mistake. I'd like for you to correct it." Okay? Then there's a process for doing that. There's a bazillion YouTube videos on how to do that and the paperwork and where do you go to file it. Okay? Or there's mechanisms, and it's right through annual credit report. And again, there's tons of videos on this, but you can flat dispute something. So let's say there's just a flat out credit card that's on your credit report that has nothing to do with you, okay? Or there's late payments. You can highlight that item and tell the credit bureau that you're disputing it. That doesn't belong to me. I've never had that card. There's mechanics that fall into place where they have to, the crediting company has to reply within a certain amount of time. I think it's within 30 days. And if they don't, that item is supposed to come off your credit. Okay, so I'm not telling you to dispute legitimate things. That's called fraud. But if there's anything that doesn't belong on your credit report, you can dispute it. Now, in my example, I disputed items because they were redundant. So I had like the same credit card reported twice, and it said one was good and one was late. And somewhere in the credit card company's computers, they had me in twice. They reported me twice, and one of them was late and one of them was good. So the second one, I just disputed it. They never responded because they either recognized the error or they just didn't want to deal with it, and that got taken off my credit report. That boosted my score because there were negative things that simply didn't belong. So I don't tell everybody automatically to run their credit report. I won't call that low-hanging fruit, but it's definitely something you can do. And if you've got a lot of credit and you need to dispute things, you can do that. All right? All right, so that wraps up the Encore. Thanks for sticking around. If you have any questions or comments, make sure you like and subscribe and all those things. But most importantly, ask questions. I'll either make a video or I'll just answer your question directly. Feel free to reach out directly. Everything I got is available to you. So thanks for sticking around. Talk to you all soon. All right, CYJ now.